My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Have you ever heard of investing in distressed mortgages? This is something that I've always found very, very interesting. And our special guest today, Chad Urbshott, knows a lot about that. That's what he's been focused on for the last number of years. He's a Canadian who has purchased a bunch of distressed mortgages down in the States, lived down there for a while, is back in Canada, and joining us from beautiful Oakville, Ontario. Welcome to the show, Chad.
Thanks for having me on, Dave. Looking forward to it.
Yeah. So, hey, first things first, why don't you give us what your definition of a distressed mortgage is? How do you explain this to somebody who's never heard of these before?
Yeah, so it depends on where your listeners are all from. I don't know if they're from the U.S. side or the Canadian side.
Bit of
Um,
both. Bit of both.
bit
So
of
we got to
both.
hit everything.
Okay.
Yeah.
So on the U.S. side, they might be a bit more familiar with it, whereas on the Canadian side, you don't really hear the term very often. So distressed mortgage is just that. It's a mortgage that's either in default or someone is, and these are, I'm not talking on residential mortgages. Well, it works with the same with either commercial or residential, but we focus on residential side of things. It's basically a mortgage where someone's either behind and hasn't been keeping up with their payments, or they haven't been paying in some time. Like, could be usually by definition, if it's more than 90 days late and it's up to 120 days late, that's in default. And anything beyond that is basically a defaulted or distressed mortgage. So that's basically what it is in a nutshell. Someone that hasn't been paying for a while.
Okay. So it hasn't been paid for a while, but it hasn't been foreclosed on yet.
Correct. Right.
Okay. All right. So I'm sure that happens a lot in Canada as well. Not everybody pays their mortgages. People get behind on their mortgages. Why do we hear about that as much up here as we do in the States?
So the default rate, I haven't checked into the stat in quite some time now, but the default rate here in Canada is, like, I'm just throwing a number out there, but it's less than 1%. I think it's something like point, last time I checked was 0.3%, so 0.3% was the default rate in Canada, whereas in the US, it used to be at least 10 times higher than that.
Wow.
Yeah. So back in the Great Recession after the 2008 financial crisis, when everybody under the sun that had a pulse was given a mortgage that shouldn't have, the
Yeah.
default rate approached 10%. Yeah. So that's the difference. The banks here in Canada, they're a lot stricter with their underwriting criteria, and as we all know, Canada, the landscape's dominated by the six big banks, and then along with a couple handfuls of credit unions
Yeah.
who are tightly regulated by, I can't remember
CMHC.
yeah, well, no, the OTSP, whatever that stands for.
Okay.
It could be another set
A
of financial
government.
protection.
Yeah.
Yeah, yeah. So there's a lot of regulations that are put in place that the banks must follow. Whereas in the U.S., there are regulations, yes, but in the U.S., there's 5,000 banks, and like I said, Canada, there's six big banks along with a couple handful of credit
Right.
unions. So the reason things kind of have gotten out of control in the past, or one of the reasons, is given there's so many banks. What the way that most of the banks make money off of mortgages, more so in the U.S., is they collect the points up front. So when you go in to apply for a mortgage in the U.S., it doesn't so much happen here in Canada, but in the U.S., there's basically points that are tacked onto your mortgage. So whether it's 1 point, a point being a percent, 2 points, 3 points, 4 points, the bank wants to get they get those points on the loan itself, and then they turn around and sell those loans again. So they well, it's called a line of credit or a warehouse line in the U.S. where they borrow the money, they issue that mortgage, and then they want to turn around and sell that thing as fast as they can again, so they can borrow that warehouse line again, and then they collect the points on those. So that's traditionally where a lot of the stuff
Where
falls through the
so
cracks.
let me unpack this for a second, Chad, just to make sure I
Yep,
understood. So big
sure.
difference between Canada and the US. The reason that there's such a low percentage of defaults on Canadian mortgages is because we've got a lot fewer banks and they're much more highly regulated. Plus, their criteria for giving anybody any money is much tighter than in the States where there's 5,000 banks. And the mortgage default, it sounds like at the best of times, even when times are going good in the States, the mortgage default rate is probably 10 times higher there than it is in Canada, taking not even counting what happened in 08, 09, that sort of thing. And that's a big reason why we don't hear about it very much in Canada. And it is a much bigger distress mortgages are a much bigger deal in the US. And the other thing I was hearing was that American banks, it sounds like they make their money on mortgages up front with these points a lot more than they do holding on to them long term. So they're just in the business of churning mortgages versus holding mortgages. Am I understanding that properly?
Yep, 100%. You got it.
Very interesting. Okay, well, all right. So how did you as a Canadian, how did you get turned on to distressed mortgages in the first place, Chad?
So I'll try to keep this as short as possible because it's a bit of a story to get into it. So I've been investing in Canada for 2000 since 2006. Started buying rentals, got into student apartments, and long story short, I think it was 2012-ish. I was heading down to a real estate conference in downtown Toronto. It was put on by the Canadian Real Estate Magazine. I don't think they do
Yep.
anymore, but while I was there was a couple of vendors from the U.S. that were touting U.S. properties, like investment properties, and they're at the time they're I don't think the terminology was coined yet, but they're basically called turnkey properties nowadays, where
Yep.
a company will go in, they'll buy property, it'll fix it up, put a renter in, and turn around and sell it to an investor. So while I was sitting at this seminar, a couple of the presentations, I was just blown away by the rent to price ratio on these. They're like 5 times what we can get in
Yeah.
Canada at the time.
They're cash flowing way better than Canadian properties. Yeah. And
Yeah,
a
yeah,
lot cheaper. Yeah.
it was quite an eye opener. So I kind of took it, the endeavor myself to learn a bit more about the business, the U.S. side. And fast forward, this is into 2013. Started out down in Florida. Have been going down there for a number of years. My in-laws had a place down there, so kind of knew the areas. Started buying a couple rentals down there. That was like right in the depths of the recession. You could pick things up for a song in those days. And what I noticed was the prices were increasing like quite significant and quite rapidly, and I kind of got turned on to. So I was buying. I realized I was paying top dollar for these properties, and that was when I started learning about foreclosures, where you could buy foreclosures from the courthouse. It's called
Okay.
it used to be called. It's all online now, but there's some counties and some states that you still do go to the courthouse steps.
Yep.
So how it works during a foreclosure, you go to the auctions, and an auctioneer or some representative or an attorney or someone from the city will actually stand in the courthouse steps, and here's property 123 Main, and they'll
Yep.
start bidding up the price. It's Most of it's done all online now, but in the event, that's when I discovered that you could, buy these foreclosures at a lot better price that you could get for, buying stuff directly off the MLS.
Got it. Yep.
That was in 2013. Started buying those with the intent of fixing them up and selling them again, um, or just buying them at the auctions and turn around and flipping them basically for a quick profit. Did that till about 2015, and then I noticed again all the funds were moving in, like the Blackstones and the KKRs and
Yeah.
you name
The
it.
big guy, the
Starwood
big guys
Homes.
figured it out. Yes.
Yeah, they were coming in and buying these foreclosures with the intent of turning them into rentals, and they were at, they were paying top dollar for, the house next door that was in perfect shape. And when you buy a foreclosure, they're usually not in the best of shape.
Mhm.
Um, I was having a discussion with one of the guys, or the realtor I was using at the time, and he worked for this bigger outfit that was managing um, distressed mortgages on this hedge fund out of, I think it was Connecticut or something like that. So they're handling all the properties for them in Florida, or not all the properties, but all the mortgages. And so he said, well, why don't you start buying, like, why don't you buy the mortgages before they hit the foreclosure? You can, because you can get a better deal on them. I'm like, what do you mean buy the mortgages? Like that was a total foreign concept to me, because in Canada, that
Yeah, you
stuff
can't
never
buy somebody's
existed.
mortgage. Yeah.
No, no, and not many people in the U.S. realize that you could do that either. So that was in about 2015. I started doing some research into it, started getting a bit more educated. There's a little bit of information here and there, and interestingly enough, I was on a meetup group with like where you get notified of meetup
Yeah.
meetings coming to your area. And this one came across and it said, learn how to buy, basically it just said, learn how to buy distressed mortgages in the US from Canada. I'm like, what? Someone from Canada is already doing this? This, like I said, back in 2015. Go to the meeting, and I'd already been researching it for about 6 months and trying to get educated on how to do it. And there was, maybe it was like in a Panera Bread or something like that, or I don't know if those exist anymore, but it was in the very back of like a coffee shop or one of those places. And he put on a 10-15 minute presentation. I was like, wow, you're doing exactly what I want to do. Like, can, like,
Show me how to do
let's
it.
let's
Yeah.
start doing it. Yeah. And instead of like he was doing a course, I think it was, I said, why don't, like, can I just invest with you and learn how to do it, you know,
Hands
versus
on.
taking a course. Yeah, that there's no better way to learn than to doing hands-on, right? So what I learned from him was what basically not to do. So it was where he was getting things at like 40 cents on the dollar. So, like, if the mortgage was worth 100,000, we're picking up for 40 grand. So there's lots of room for error back in those days. And pretty much every mistake under the book was made. And I just thought to myself, after being involved with this for a year or two, I was like, man, if he can do it, then I think I could easily do this. So that led me to 2017, and yeah, just started doing that, and basically gave up everything else I was doing before that. So anyhow,
Okay.
so
So
yeah,
walk me
long
through this.
story
So
short.
these companies own the mortgages that the banks have generated,
Yep.
and they've part of their mortgage portfolio is in default, it's distressed, and they're willing to sell these mortgages to guys like you for a significant discount. Um, then what do you do with them? So once you own one of these defaulted mortgages, are you foreclosing on that property, or how are you recouping your initial investment and making some money?
Yeah, so yeah, the discounts aren't nearly as good as they used to be back in those days. The 40 cents on the dollar are long gone. It's more like 80 cents on the dollar
Hmm.
nowadays. But so the first thing we do is we pick these mortgages up, is we've got what are called mortgage servicers. And mortgage servicer is kind of like a property manager for a property. So property manager, goes around, collects rents from people, repairs properties if things come up. What a mortgage servicer does is, yes, they do the collection of the payments when they're coming in. But if they're, if you buy a mortgage that's distressed and the people aren't paying, obviously, you have to reach out and contact them. So that's what the mortgage servicer does. They're kind of like a debt collector, so they'll start reaching out to the borrower, getting to the bottom of why they haven't been paying.
Hasn't the
And
bank already
if
been doing this for a while before you get involved?
Yeah, yeah. It depends on where it comes from. Sometimes the bank will give up after a few months, and if
Hmm.
it's off their 90 days or 120 days not paying list, they'll just sell them off. Yeah, sometimes we'll get them from a different fund that's been trying for a couple years to get through to a borrower. Um, but oftentimes these are coming from bigger funds or like bigger
Yeah.
banks, and they're these borrowers are just in numbers oftentimes, and they're not really given much chance. It's either like, let's say they're $10,000 behind. The bank says either pay the $10,000 or, we're going to go right to foreclosure. That's not always the case, but that's just
Yeah.
one scenario. Whereas, if we get the loan and it's $10,000 behind, we might say, hey, listen, like, you tell the mortgage service, say, just feel them out for what their situation is and see if they can come up with any, even like $2,000. I'm just throwing a hypothetical number out
Mhm.
there. Okay, if you can put $2,000 down, we will work with you to start making your payments again. And if you make, a certain stream of payments for the next 6 to 12 months, we'll then turn around and take that whatever's remaining of whatever's outstanding on your arrearage. It's called an arrearage when you're behind,
Yeah.
and we'll tack that on to the end of the mortgage again. That's just one scenario of several. So that's the first thing we want to do. Is always want to work with the borrower, give them a chance on getting them back on their feet again.
Yeah.
Um, and that's always the best scenario, the win-win scenario. And then the last resort is going to foreclosure. So if borrower, if either we can't get a hold of them or they're just not cooperating, we'll start the foreclosure process, and that's typically done through an attorney down in the U.S. where depending on the state, so in the States, there's either judicial or non-judicial. Judicial means you have to go through the court system. Non-judicial is basically got to
You
do
don't have to go through
publications
the
in
court
the
system. Yeah. Yeah. Yeah.
yeah, yeah. But in either case, you have to hire an attorney to go through the process. And so oftentimes, especially nowadays, with the increase of real estate prices since COVID, most people have equity in their homes now. So if they're not cooperating before you start the foreclosure process nowadays, unlike when I first started, when they were underwater in their mortgage, meaning
Yeah.
the balance was more than the property's owed. A lot of times people just walk away because it wasn't worth it. Their credit score was already ruined, so they would just like, just foreclose me out. They would just walk away from the property. That used to happen probably more than 50% of the time back in, first started. Nowadays, it's more, I would say, like it rarely ever you go right to the end of it on a foreclosure. So, but what the foreclosure does is it kind of lights a fire under them and say, "Oh man, I guess I better
Better
pony up
get better
here."
get this sorted out before I lose my house and all my equity. Yeah.
Exactly.
Yeah.
Yeah, 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 exactly.
So
So
maybe
that's
maybe Chad,
so
let's
one
let's look at an
extreme to the other.
example of
So,
trying to figure out how the money's made in these kind of deals. So maybe
yeah.
do you have like an example that pops into your mind? Like, here's a deal where the property is worth this much, the mortgage on it was this much, they were this far behind, and here's how the deal worked. Can you walk us through an actual example just to paint the picture a little
Yeah,
clearer?
yeah, absolutely. So I'll use just hypothetical numbers because I don't have
Yeah,
anything right in front of me at the moment.
but
But just
realistic if you would, like
yeah,
yeah,
yeah. So I'll use an example, and your U.S. listeners will be accustomed to these kind of numbers, whereas Canadian listeners won't.
yeah,
So, everything in Canada is like $1 million and up for a house, but you can easily buy a house for 100 grand or even 50 grand in the U.S. So let's say there's properties worth $100,000. The mortgage is $80,000 on it. Outstanding, they're $10,000 behind. So they owe $90,000 on it. So the outstanding balance, like I said, is 10,000 or 80,000. They owe 10 or they're
yep.
behind $10,000. Let's just say that's interest accumulated and the property's worth 100. So we could go in, like I said, yesteryear, we'd be able to pick that up at
Well,
say forty or
let's
fifty
look at
thousand
today.
dollars.
Let's look at reality today.
Yeah.
Yesterday's gone. So what does it look like today?
So nowadays we could probably get it for like on the entire balance 65%. So let's roughly say we could pick that up for $70,000. Um, so
So
then, like I said, we get
65% of the value of the house or 65% of the mortgage amount.
yeah, the mortgage amount.
Okay,
So
so the mortgage is
um,
80 grand. They're
yeah,
10 grand behind, so that's
yeah,
$90,000 owed.
yeah.
65% of that would be closer to $62,000, give or take, right?
Yeah, I think I was using 70,000. So
Yeah.
that's 63%. So you pick it up for we could pick up the mortgage for say $70,000.
Okay.
I'm just using round numbers here.
Got it. Yeah.
Um, so in the very first scenario I gave you, where the servicer reaches out to the borrower, oftentimes, like I said, if they're just a number, the borrower is just a number, and they're with so the majority of mortgages are serviced by mortgage servicers in the US, but some of these mortgage servicers, they handle millions and millions of loans,
Hmm.
and they
Lots
aren't really
fall
given the
between the
time of
cracks,
day.
is what I'm hearing.
Yeah, yeah,
Okay.
exactly. So oftentimes, by the time it gets to smaller guys like us, we use servicers that only may have, $10,000 or 10,000 loans. So they can spend a little bit more time with the borrower, continuously calling and reaching out versus just sending letters. Like a lot of times they just get a letter in the mail, letter in the mail. But our services will call them, reach out, talk to them on the phone, so they can get a hold of a live person. So it might be a case of, they lost their job for 6 months, but they got a new job now.
Yeah.
Um, they tried reaching out to their servicer. They don't have the $10,000. They've only got, like I said, the example before, they
2,000.
have 2,000.
Yeah.
The servicer will turn around, and ask me, say, "Hey, would you be willing to take $2,000?" And I say, "Yeah, let's give them a chance." Let's say their payment is $500 a month. So they put 2 grand down. They make 6 payments of $5,000 or for $500.
500.
So we've now collected 5,000 over that, and then we take that other 5,000 that they were behind, and we'll tack that under the end of the mortgage. So we've collected 5,000. The mortgage was 80, but they owed 10. They've paid us 5. So now the new mortgage balance is going to be $85,000.
Okay. Yeah.
Yeah. Okay. So once we've got
And
it's
you've
called
paid
a
70,000 for this asset,
yep,
right?
yeah,
Going back to that
exactly,
example. Okay. Got it.
yeah. So let's say 6 months have gone by, they've made all their payments. We'll put them in what's called a loan modification, which basically it changes the terms of their original mortgage.
Okay.
Um, like whether the interest rates change or the payment amounts change or the amortization's changed. Oftentimes we try to keep the payment the same, or we'll try to knock it down, just to give them a break, or
Yeah.
take the interest rates down. Well, we were taking interest rates down, and now they're going back up again. So
Yeah.
we usually don't give a break on interest rates as much as anymore, but we'll extend the amortization. So let's say in this case we'll just keep the payments the same, so they're back on track. They got income again. So we'll keep the payments the same at $500 a month.
Yeah.
They continue to make that for another 6 months. And once someone has made a payment stream for, like, say, 12 months, usually in the industry, we call that seasoning.
Okay.
So once we've got 12 months of payments, that usually indicates that, they're probably going to continue making those payments again.
Yeah.
Now they're back on track. The default rate is still higher, like it's still probably a 30% chance they might default again, or a 20% chance, but at least it's not in default anymore.
Yeah.
So now that we've got a steady stream of payments, we could turn around and sell that loan again back into the secondary market, they call it. Um, let's say, just throwing an interest rate out there, let's say the interest rate on this loan was 8%. Well, some people in the US are very knowledgeable about buying mortgages, and putting them into their retirement accounts, like an
Yeah.
IRA, which is the equivalent of an RRSPs here in
Hmm.
in Canada. So they might want just a steady payment stream, and it's called mailbox money, where they just buy this mortgage. They don't have to.
You don't have to
It's not like
deal with
having a
tenants or
rental.
toilets. Yeah. It's
Exactly. Yeah.
they're buying a note, as they call it down in the States. Yeah.
Exactly. Yeah.
Yeah.
So let's say they want a 10% return. So I don't have my calculator in front of me. It'd
Well,
take me
yeah.
a
So
few minutes to run the
they'll
number.
they'll discount the amount they pay you for
Yep.
that mortgage, so that it comes out they're making a 10% return on their money.
Yeah, yeah, exactly. So in this case, let's say the balance, like I said, was the new balance is $85,000 that's owing, 8% interest rate. they would discount it enough, say they wanted 10% return on their money. So they might pay, I'm just throwing a number out there, let's say like high 70s, like 75 to $80,000 on it.
Okay.
So that's where the profit comes in. You collected a small down payment, you collected 12 months of payment stream of $500 a month, so that's $6,000. So you're, in your pocket, you've got about $13,000, and then you turn around and you sell it for, let's say $77,000 versus the 70 you paid for it. So all in, you've made about $20,000 on your $70,000
investment. Yeah, and now
Yeah.
obviously
there's some expenses in there as well.
You got to pay the debt collector guy or the
exactly.
What do you call it? Mortgage? What was the term for it? Mortgage
servicer.
Servicer, right? Yeah, they've got to get compensated as well. Okay, very cool. So that's been your main focus for the last number of years. I know you were living for a while down in Florida, but now you're back in Canada. You're doing this cross border.
Yeah. So, like I said, I started dabbling in this 2015, and connected with the other guy in Canada that was doing this. I was actually pretty much down in Florida at that time, almost full time. And then 2017 came along, and for personal reasons, had to sell our place down there and move back. So when I moved back, so what I was doing before, like I said, was buying foreclosures, fixing them up. I had to be there, like, manage contractors, going around looking at properties, looking at several a day. So back in 2017, I was like, what am I going to do now? I just got this business kind of started up off the ground. What can I do to, stay, like, keep doing something similar in the US, but be able to run it from basically anywhere. So when you buy the mortgages, you're basically buying the paper, you're not buying the property. So you never have to see the property. It was just I wouldn't say it was a no-brainer. I mean, it was a lot of headaches trying to get things up and running. But yeah, I've been, like I said, since 2017 doing that full time, and
nice.
But nowadays with the internet and cell phones, you can run a lot of businesses from anywhere. With COVID, working from home, there's a lot easier to run businesses that you couldn't 10 years ago. But yeah, this is it's a run from anywhere. Like I know a couple of guys, like I'm in a couple of groups, distressed mortgage groups that are in Israel, like different countries overseas that are doing it. So a guy from Australia. So it can be done from anywhere. Not easily, but it can be done from anywhere. So, but having said that, most of my colleagues are U.S. based, and they it doesn't matter where they live, they buy loans from all across the country as well. So it doesn't really make a difference.
Yeah.
The only tough part about it is the cross-border stuff, but I'd already had that all set up prior to
so you're not getting whacked with taxes twice, right? That's the
I figured that out the hard way back in 2012, and ended up getting U.S. visas, and all the the social security numbers and all that at the time and what have you. So I had all that the really tough part figured out before, but
very cool. So Chad, time flies when we're having fun here, my friend. So if people want to connect with you and find out more, what can they do?
Yeah, sure. You can go to the website. It's www.equogrowth.com, and that's EQUIGROWTH.com. You can go on there and contact me, or fill the contact form, or I'm on Facebook, LinkedIn. I'm sure my name will probably be in the notes here. It's a pretty unique name, so if you Google me, you can pretty much find me.
Easy to find. So. Awesome. Well, thank you very much for sharing your insights into distressed mortgages and how that works. I really appreciate that, Chad.
Yeah. No, thanks for having me on, Dave. Appreciate it.
All right, everybody, take care. We'll talk to you on the next episode. Bye-bye. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.